I don't see it.
That didn't catch up.
We have to care about agents. Screaming at a drag show, so. Right, I'm like, okay.
The pizza boxes.
Right.
So we.
So I'm sitting here with Wesley Graham from Cross Country Mortgage, one of our, is basically our in-house mortgage partner with the Heritage Group. And we were just kind of talking before about a little bit of the nuts and bolts of what's been happening. And I just said, I'm like, hey, like, why don't we get kind of on the mic and just like talk about it? I think it's going to be great for agents. I think it's going to be great for consumers. Recent announcements in the mortgage industry. Obviously, I'm going to let you take it away, when it comes down to where we're going to go with this. But Fannie Mae recently made an announcement kind of about the averaging of credit scores when it comes to borrowers. I think there's going to be a huge misconception that, okay, I've got a 500 credit score, grandma's got an 800. We're cool. I'm gonna get this loan. I'm gonna get this house. Not necessarily the case. So kind of like walk us into that a little bit.
Yeah. So I think that's a very common misconception. I think, they made that release and you've seen some kind of headlines in the news. I've even seen publications get it wrong. So it's important to kind of understand what an AUS is, an automated underwriting system. I think that really kind of helps you understand. It's a good vocabulary item for you guys to know. So what they're actually doing, in the mortgage industry, you don't really have co-signers per se, like you might have an auto loan,
Right.
where you have someone who's made some mistakes in their life, right? And now we've got somebody who's a little more organized coming in and co-signing. In the mortgage space, historically speaking, and really continues, the lower score dominates, what the loan's going to look like.
Right, because that's where the risk lies.
Right. And so what they announced recently, I think, confused a lot of people because they essentially said, hey, we're going to be averaging scores. But what they're averaging scores for doesn't affect pricing. You're still using the lower person's credit score for pricing. It does not affect the eligibility. So 620 right now is the eligibility number for conventional lending. And
so 620 is the lowest credit score that you can have in order to be eligible.
the lowest middle score.
Middle score
Right.
to appear and be eligible for
Conventional
lending.
loan. Right.
Okay,
Now,
gotcha.
and that could mean a lot of things. We could go
Deep
crazy
into those,
on that, right? I mean, because you can do 3% on a first-time purchase as a conventional loan, right?
Right.
Well, not if you have a 620.
You're right.
Probably not.
Yeah.
Probably not.
There's a lot of other variables that will go
Yeah,
into
it's
it.
going to be a lot more gray, right?
Right.
This is an FHA. It's not a government
But
program.
you're in the 550 realm, 580, whatever. Don't even consider it.
FHA,
Yeah,
VA, something
right.
like that. But so nonetheless, it doesn't change the eligibility. So if you have somebody that's 619 and someone who's 750, you can't have that 619 on the loan. This doesn't fix that. What this does change, however, is how the AUS, the automated underwriting system scoring works. So if you have somebody, and what an automated underwriting system is essentially we're taking in all this data. It's the vast majority of how loans now are originated in the country, and it's an algorithm. It plugs in all the data, the cash on hand, lots of things, okay?
Right.
And it spits out, hey, this is approve eligible. A, this is approvable, and B, it's eligible to be sold on the secondary market by the terms of Freddie Mac and Fannie Mae. And so what has changed is the way that algorithm picks up credit scores for an automated approval, assuming both borrowers are eligible. Pricing, again, is still based on the lower person's score, but now that automated system will pick up that total profile and average the scores.
Right. So we're looking at something like if borrower one has like a 680, borrower number two is like a 720, both above that 620 mark, we're kind of falling in like the 700 range.
Right. And again, the way
instead of only that 680, like, okay, here's the lowest.
Right.
It's that 680 is your, like, even if it was 800, it's like you guys are still sitting at 680.
And what it's avoiding is, again, it's now allowing you to do an automated underwriting approval, which dramatically simplifies the requirements from a debt to income ratio standpoint, from a reserves, et cetera, but also seriously reduces documentation. Because what you're avoiding then is a manual underwrite of the file. So there are plenty of loans that can be approved that don't get an automated underwriting approval.
Right.
But they require manual underwriting. So
It's
now
going to increase, right.
Yeah, It can be
Yeah.
special,
Yeah.
right? But it also then, it lowers the debt to income ceiling. It just makes it harder to be approved. So
Right,
this is a big change, and it is going to make things really helpful. Let's say you have that person that is 621, and they're borrowing with somebody who's 750, and maybe a week before, yeah, no, you're not doing 3% down. You're doing 20%. You're
Right,
doing 25%. Now being able to take that average might mean that you see some more forgiving loan to value. You might see some better things along those lines. But the interest rates are still going to be rough if you're lower.
Right. So, and it's funny that you bring up interest rates because I think that's another important kind of aspect that we definitely hit on is the fact that the interest rates are going to vary based on the type of property that it is. Like what kind of would be not even so the elevator pitch, but just like the straight shot of like primary resident, investment property, second home,
Sure.
and kind of like how those look.
Yeah. So, in a broad sense, risk reward, right? If someone is going to purchase a loan, right, that we've originated, the riskier that loan's profile is, the more rewarding, the better interest,
Right.
Right. Not to the borrower, to the owner of the loan,
Right.
The higher the interest rate needs to be, and so the more likely a loan is to default based upon history, and what we know of
Default meaning not actually reach the longevity of the loan to be paid in full.
not necessarily that they reach the longevity, but just that it's not paid in full.
Paid in
Because
full,
you do
okay.
have loans that pay off early, they sell it,
So-
whatever.
Okay,
but
gotcha.
right.
So it's just that it's not paid off in full is the default.
Yeah, and it's not just occupancy type that affects this. Condos, can be priced differently than single family homes. They're riskier.
Right.
Duplexes are riskier than a single family home.
Is that anything about like just because of the nature of the property?
Yes.
Like it's not a single family home where you control like your whole lot, the whole 9 yards. It's like I share a wall with this person or what.
Right.
I got to get out of here. I'm out. Peace.
Right.
Okay. Cool.
Historically, they don't appreciate as fast. You have all kinds of factors.
And these are all great things that I think both agents and consumers should be aware of.
Sure.
Is to like that's what's going into it. It's not like, well, I could have bought a $400,000 house. Why can't I buy this $400,000 condo? I don't know if those look different, but there could be little caveats like that are
HOA dues is the big reason, but
there. So there you go.
anyway. But yeah, so occupancy type is a big one. Predominantly investment property versus any other type, much more expensive. Historically speaking, you look at the Great Recession, those were the first properties that people gave up. When things got ugly, when they got underwater, I don't live there. I don't really care about that tenant. I'm not paying it.
Right. So like to kind of break that down would be while watching something like The Big Short when Steve Carell and his crew goes to these homes and they're knocking on the door and the tenant is fully unaware that he's not been the mortgage hasn't been paid. He's been paying his rent every single month and the mortgage has not been paid because the person that actually owned that needed that cash, and just like you're saying, I'm just going to swallow that cash. I don't whatever.
Well, and in that case too, they were underwater, right? And by underwater, of course, I mean they owed more than what the house was at that point
Ever worth.
right? Maybe not ever,
Ever,
but
but
in that situation,
right.
But so that's also why investment properties, second homes, require bigger down payments than primary residences. Because if you're underwater on the house you sleep in, you're less likely to wash your hands of it.
Sure,
right?
yeah.
If you're underwater on investment property, it's an investment. So if it's a bad investment, you're
You're just going to walk away. Yeah, right.
cut bait, right? So same thing with second home. You're less likely to walk away than an investment property, historically speaking.
But still, there's a risk.
And which is why you have to put more down. So interest rates then are going to reflect the same thing. Second homes, a little bit more than primary. Investments, a lot more than primary. And so then there's strategic ways that we can address how a buyer is going about buying a house to try to get them the best deal and make sure it all makes sense. But that's just going to be one of those factors. So, and we had talked about a recent change, something that happened back in March. So back in March, lenders were essentially told by Freddie Mac and Fannie Mae to reduce the number of loans that they were delivering for second home and investment properties in relation to the size of kind of their overall portfolio.
Okay.
And
that is fairly huge, yeah.
Yeah, and kind of new, I've never done that before in that way. And so
do you think that kind of was rooted anywhere? Like that was just like, here's a good idea? Or like, is that kind of backed by sort of any sort of speculation at this point?
I didn't dig all that deep into it. I kind of made my assumption was, and I think it's a reasonable one, is, you have seen a big shift here in the workforce as far as people being able to work remotely, and some of that might be permanent, some of that may not be permanent.
Right. It was temporary for so long that they were like, it's going to be permanent.
Yeah, and I think in a lot of places they're seeing workforce efficiency gains with people working from home,
Right.
which may be sustainable or may not. But I think the concern would be is okay. And ultimately, I have seen it empirically. A lot of people are buying second homes that they're intending to move to Florida, right? Maybe they haven't been told, I'm going to be in Florida forever, but, they're
Like, you're right.
that's what their plan is.
I'm remote. In
And
Florida.
so if we're seeing a ton more second home purchases, is something in society changing that a lot of people are buying these second homes, and
Right.
maybe that's not sustainable. And so I think that change, and then in a change with appraisal waivers, which we'll talk about in a minute, I kind of feel like it's rooted in that. A little bit of a concern of, hey, let's pump the brakes. A lot of people are buying second homes and investment properties that maybe aren't actually intended to be. And if all of a sudden society changes back,
right.
I've bought this house that I really only could have afforded if I was going to be able to live there.
Right.
Even if I was technically approved because I could afford it.
It's a longevity issue.
Maybe I stretched more than I thought I would have otherwise.
Right. Which is still a general concern. I mean, because you got to think, if you're a real estate agent and you're getting information from your client and you're like, hey, like, this is what we want to do, whatever, that could turn around and come back on you as far as like just a small smear. Like, yeah, I know you're not the one that decided that, but it's all just wrapped up in this terrible sphere of like being educated and saying, this is why we have people like you, is educating our agents here. Like, hey, I would talk to these people kind of about this, especially if they're going to need this % down. It's going to be this interest rate. Like, maybe they shouldn't stretch as far as they think they can,
Right.
on the off chance that something were to come up and they'd be like, wow, like, glad we listened to Cross Country Wes, my agent,
Right.
whatever it is, because those things are going to be important.
Yeah, I mean, and at the end of the day, you can lead a horse to water.
Can't make them drink.
Right.
Yeah, right.
But I mean, absolutely, it's something that's important to kind of understand. And I have had conversations with people where I just had one before we hopped in here where, hey, yeah, sure, I'm going to be able to work from Florida, and really this deal we were looking at only makes sense if that's going to happen. Well, are you going to be able to work from Florida, or is this saying hey, no, it's going to work, it's going to work? It's like, there's consequences. You've got binders out. There's you're under contract,
right?
And if it's just important to really do this work up front.
Yeah, 100%. I mean, you're right. And that's what we are constantly educating. And that's, again, why we work with you guys so closely, is that so that we don't have these things fall through. And we're kind of like on the front side of it saying like, hey, this, this could become disastrous if this guy is not right? He's going to wind up losing money. He's going to blame you. He's going to blame everybody because, if you're stranded out in the middle of the ocean and it's you and me and we're both drowning, right? It's not going to matter whether it was his fault or not. Like, he's going to shove your head down to stay afloat.
Yeah. Well, and so kind of to wrap up there, though, is they recently have gone back and changed back.
Okay.
That delivery
fantastic.
ceiling on second homes, and similarly with the appraisal waiver thing, they've reversed course on it. What you did see then, though, is second homes became slightly more expensive. Interest rates.
Okay.
Investment properties have always been more, so it really wasn't all that noticeable there. But in second homes, whereas it used to be very, very close to primary residence, now there's a little bit of a kicker, where those loans are priced a little bit more expensively. It really wasn't dramatic in most cases, and I think most people, most buyers understand. Hey, it's primary residence is
where we're going to live,
as secure a loan as you're going to get, right? But so they've reversed course on it. Honestly, I haven't noticed
a huge
substantial shift on that, but it is something that happens.
But I was going to say, it's still something to be aware of, because if you're not hearing it from your agent, or you're not hearing it from whatever the lender is, that's kind of going to be an issue.
Well, and I think also let's say you've got a buyer, and we run into this a lot, where they're looking online at these hilarious interest rates,
Right.
Now they're not looking at the $5,000 point buy down they're going to have to make, or frankly that lender can't close ever on time, or whatever those factors might be. But also, if someone's buying something as an investment property and they're trying to rate shop and they're looking at 2.75, it's like, buddy, that's not how that works.
Exactly.
That's not how any of this works.
But that goes back to what we talk about. It's just education.
Well, yeah. So as far as Freddie Mac, Fannie Mae, if they limit the number of investment properties and second homes that they're taking delivery of, essentially,
Right.
That means that for us to continue to profitably offer those loans, there has to be a little bit of a price difference, right?
Right.
And ultimately that price is getting passed on to the consumer.
It's getting passed off to the consumer.
Correct.
Now, we briefly spoke about appraisal waivers, and again, not being a licensed agent, but just working in the industry, I know of 2 different types of appraisal waivers. I don't know kind of like the weeds of them, but essentially my understanding would be an appraisal waiver is like, hey, we're going to pay this much for this property, whether it says we're overpaying or we're not. Like, we want this home. This is what we're paying for it. Not cash over appraisal. Not this. It's just we are waiving the appraisal of this property. Kind of talk me through like why that might be not good, and then obviously that's a pretty strong offer when it comes from the buyer.
It's clearly what you want to see.
Right.
Yeah. So, I think the key thing to understand is kind of the arena, right? Understand the setting, because a lender might offer an appraisal waiver, and that's a very different thing than an agent, buyer offering to waive the appraisal on an offer, right? On a contract. And it's from our side, we see it very chicken or the egg, where an agent thinks a situation might get an appraisal waiver, and so they get very like, oh great, and we're going to offer an appraisal waiver, thinking that that's that we might be able to offer it on our side. Well, we don't know until really the property's under contract. We've got the application complete with the property address in there, and then we're running it through that automated underwriting system that we talked through before.
Right.
And the way that an appraisal waiver works on our side, and this is one of those things that changed, similar to the interest rate, new difference that we saw happen. So an appraisal waiver for Freddie Mac or Fannie Mae, okay, it has to be 20% down, all right, in order to be eligible, and that's only eligible for it to maybe happen.
Right.
Okay?
So let's not lose course on the fact that it's like, oh, you need to have 20% down. 20% down is going to be a threshold to even, just like you're saying, say, we're going to waive the appraisal. If you're coming in with just, hey, we have this cash, here's the, whatever it is, don't even look at it, right? Like, don't even consider it.
Right.
If your agent's telling you or whatever it is, like, it's just, you're not even going to be able to be
Has nothing to do with the offer.
Right. You're not going to be able to be entered into that arena.
And frankly, there's not a lot so the algorithm is proprietary, right? And proprietary, in other words, it's their own internal algorithm. Freddie Mac and Fannie Mae, sometimes you'll get an appraisal waiver with one and you won't with the other. It seems like Freddie Mac's a little more liberal with it. I get them more on Freddie Mac than I do Fannie Mae. Couldn't tell you why. It's proprietary.
Well, right. So proprietary meaning that like you don't know what's inside. You don't know what they're looking at, right? You can only assume what they're looking at, which means if someone else told you otherwise.
Yeah, either they work for Freddie Mac and Fannie Mae and are going to get in trouble for sharing trade secrets, or
right,
or
they're just it's just not good. Not good data.
And there are circumstances that you tend to find contribute to an appraisal waiver. I can look back at the loans that I've done and when one's been granted, and I can tell you these are the sets of circumstances where I feel like it could happen. Right. But it's really an unproductive thing to get into the weeds on at the offer stage, because again, it's chicken or the egg. We just don't know. I've had ones where I'm like, they're putting 50% down.
100%.
This purchase price totally seems reasonable. I don't understand a scenario where this doesn't appraise. And nope, sorry, got to pay for an appraisal. It is what it is. Is what it is.
Yeah, right. No, you're totally right.
And then there have been ones where I'm like, man, I couldn't have imagined that house was worth that, and got an appraisal waiver. Great. So again, just not productive to really get in the weeds on it as an agent. But just one of the things that I think is important to know on there, though, is, again, earlier this year, just like with that delivery of second home and investment loans, they basically said only primary residences 20% down or more can be eligible to even be considered for an appraisal waiver. Okay, so if you had, say, 10% of the total second home or investment properties that were closed in America were getting an appraisal waiver beforehand, and all of a sudden that stopped like that,
right?
That means that 10% or more of the appraisals that were being ordered for investment homes or second homes suddenly jumped up.
Right.
Does that make sense? Right. So I wouldn't necessarily get too excited about them being offered again for second homes investment properties because
Right.
you just never know.
Right.
But on the other hand, having some percentage of those waived again hopefully helps with the nightmare we're having with appraisal delays.
I was going to say, you're right.
and
Delays.
It's a logjam.
Yeah.
It's a-
I remember you saying that. We spoke kind of a few months ago now. You were doing some work for us here and just kind of in education about, the certain types of things. And that was a huge bottleneck that you were talking about.
It's the one.
It's like we're literally just like,
Right.
literally we can't do anything. We're
Right.
just sitting here with dead in the water.
And so I think, similar to my reasoning as to why I think that they were limiting loan delivery, I think that appraisal waiver factor was the same kind of thing. It's like, hey, if we've got people buying second homes, investment properties during this bizarre upheaval, and investment properties, eviction moratoriums, maybe I'm not
Right.
getting rent paid.
Right.
I think that they were saying, hey, we want to make absolutely sure that these properties are having a professional appraisal done that's taking into account local market factors.
Right.
Not some computer algorithm that's hoping it's right.
Right. Correct.
So, and so to some extent, that lifting, I think, is an acknowledgement of how bad the appraisal jam has gotten. But also maybe it's an acknowledgement of, okay, well, we're kind of getting to this place where this work remote thing has become a little more concrete. Who knows?
Right.
I don't know.
I think it's also important to understand too that a computer algorithm is only as smart as what you tell it.
Right.
Right. So
The
like
inputs.
we have we had an instance where we had a home that had a cash off, like some sort of instant cash offer program on it in like the 460s or let's even say the 5s.
Okay.
And wound up selling a cash offer from an actual buyer, $875. And then all of a sudden you go look at the proprietary estimate from this online software and it was $1,000 over that sale price. I'm like, no way that thing guessed that somebody else was coming in here,
Right.
until it got that information and said someone just paid this for this, right? It's probably worth this, right? So I think that's very important to understand that, right? You're going to want to not always rely on the computer or the algorithm as so much as just relying on like a lot of data that gets input and finding out recent home sales, right?
Yeah, and so, backing up a little bit, I mean, from an agent's perspective, what's important to then understand is when you are waiving an appraisal contingency in an offer, what you are saying is my buyer, regardless of the appraised value, right? My buyer has the cash and is comfortable paying whatever we said we agreed to paying up front.
Right.
And I think there are situations where that makes sense to do. Super competitive, very unique properties, and a buyer with so much cash they don't care. Then it makes sense. And I've had discussions with agents where we got really, really like, well, should I do 200,000 cash over appraisal? I'm like, it's a 5,000 square foot house. It's not going to appraise for $100,000.
Right.
You could probably be okay waiving the appraised value as part of the purchase price because they've got $500,000 in cash they're willing to dump into this. Right. And that is really strong. If you're competing with cash, hey, look, yeah, we're financing, but we do not care the appraised value. We will cover the difference. Period. Right. Or we'll lose our binder. Right. So now the key thing is, though, is on the other hand, just because you think, hey, this is probably worth it, maybe it'll get an appraisal waiver from the lender's side. Even if you've got one and they're putting 50% down, we may still need an appraisal. It doesn't mean an appraisal doesn't need to happen. Right.
Correct.
And from an offer perspective, it just means no matter what it's worth, we're paying it.
We're still paying it.
Right.
Got it.
And I had a deal, perfect example, guy, bought a really cool house, really unique property, chicken coop, he bought a homestead.
So it's like, farmland.
Yeah. 5 acres. House there was nothing anywhere near it that was nearly as nice. It was never going to appraise. Right. He did not care.
He just wanted it.
He just wanted it, and he was competing with a lot of other people just like that. So in his case, waiving the appraisal contingency insofar as the value was concerned, he was good for it. It was going to be fine. He could justify expense. But you just want to make sure that you're not, from an agent's side, that you're not conflating those two things and getting yourself in trouble and saying, hey, we're waiving the appraisal, and then turn around and have it appraise 100,000 short, but they only had enough to deal with a 50,000 short. uh-oh,
That's right.
you know,
You're
now
you're SOL.
now you're in trouble.
Yeah.
So you know, I think that's a very important distinction.
It definitely is, because it goes back to what we're talking about, is that we're trapped out in open water. Who's the first person that's going to go down, especially if you were the one, you know, that advised them poorly. And that's where, if you really go into the weeds with E&Os and insurance and stuff like that, it's like where, you know, you advised against this, that, and the other. Like, it's just why.
Right.
Like, don't talk about something that you're just like,
Yeah. And so
just to get the deal done.
exactly. And so big picture, you know, I think it's great what's happening with appraisal waivers coming back for anything but, you know, for other things than primary residences. But the effect on your day to day, you know, it's a big picture. Big picture, it's going to help. You know, I really see it helping with the appraisal situation, because I've seen them climbing a lot just lately, which is crazy. I thought we'd seen the worst of it, but so nonetheless, you know, with that hopefully cooling down a little bit, hopefully see appraisal prices on aggregate start to come down.
Okay.
Delivery times speeding up, because again, if you're taking this percentage out of the market that appraisers need to pick up, you know, hopefully it lessens the supply crunch.
Yeah.
Exactly.
All right. Awesome. Yeah. I mean, as we work very closely with Cross Country and Wesley's team here, because yeah, this knowledge is very valuable, especially when you're in such a competitive market. I mean, here in Jacksonville, North Florida, it's like one of the most competitive markets, as we've seen. It's
madness.
Yeah, it's absolute bananas.
Yeah.
So knowing as much as you can possibly know in order to make sure that your deal is going to be the strongest, because I can't imagine that anything's worse than you present this offer, agent's like, hey, like, guys, this is a great offer, and then the thing crumbles. Now, not only does the seller hate you, that agent hate you. That agent's not going to want to work with you again. It's just like all this happening, when it's like, if you just had the knowledge, or you just were very transparent with, especially a team that's as strong as you guys, you're just going to wind up doing better business.
Yeah, and it's really tough, because you're really wanting to put in. You really want to put in the most competitive offer, right? Because we know it's super hard to win offers these days.
Yeah.
But at the same time, you know, you want to make sure that offer is going to close.
Yeah, right.
Right?
I mean, that's the goal, is to put your clients in that house.
And have plans for, you know, hey, if we're going in over asking price and we don't have supporting comps, does your buyer have cash? You know?
Yeah.
And are they comfortable? You know, you can do a lot up front to say, hey, look, you know, this is the nature of the market. Here's a nice pool home. You want to pay a premium based upon some unique features of this house. You know, give them that up front, that, hey, this may not appraise, and what is your plan?
Yeah, right.
For if it doesn't appraise.
Right.
Are you backing out, or are we, you know, so when they're putting in that cash over appraisal offer, they know what that means. Mm-hmm. And when they're not putting that cash over appraisal offer, you're really gauging, hey, if this doesn't appraise, are we walking away, or are we negotiating with the sellers and figuring this out?
Right.
Because I've seen a lot of deals saved. We're doing a little bit of work up front and really prepping that buyer. I mean, this one that I'm talking about that was out in the country, $200,000 appraisal shortfall. $200,000.
That's a steep chunk of, yeah.
Whatever. Cool. Sounds good. Wrote a check. Well, I sent a wire, but you know.
But either way, like, had that been, yeah.
Right? It's like, hey, look, this is a rural property. You only need it to appraise at half of the value, because you're, you know, a little bit over half, because you're buying it at.
But that would have been a huge
50% down.
A huge jump on, you know, it's just like, hey, like 200,000, like.
It might have been one. I don't even remember.
Either way, I'm like,
but it was crazy. It was a large.
I was gonna say, that's a huge shock to, like, if somebody that's like thinks that, like, oh, we'll do it, like, we'll be fine, and then you're like.
Yeah, and him being coached up front and having a plan up front, and it very conveniently did not change the terms of the loan at all. It was like, had it been over 69.99% loan to value, his rate would have gone up, and it literally was like 69.7%. It was like the silliest. It was like,
yes,
perfect,
right.
Perfect.
That's too funny. Well, dude, I appreciate you coming on here. Obviously, we've spent a lot of time together. We were just at the Jags game. We tried to hit it a lot. I mean,
your cooler's in my truck, by the way.
Oh, rock and roll.
Nice.
All right, awesome. Well, anyway, Wesley Graham, Cross Country Mortgage. We work closely with these guys. These are awesome. Appreciate you coming on, man.
Thank you.
Yeah.
Adios.
See ya.